We might be seeing the bubbles of all bubbles here, with the market being extremely top heavy. We haven't seen market signals like this since, yes, the Great Depression. I know you might think that this is hyperbole, but I'm going to break it all down for you as to why the stock market being so top heavy could lead to the potential of the bubbles of all bubbles, and then potentially could watch that burst. Look, I don't think we're going to burst any time soon here, because I think we're going to get into all of that in this video. But first, I mean, the dramatic shift that we are seeing from the top 10 stocks and the rest of the market is astronomical. The gap between CPI, real inflation, is in the region of 10%. The S&P 4,900 or 490 has basically no earnings growth since 2022. It's just 10 companies doing really well, while the broader economy is in a contraction in real terms. So with this, right, we're seeing tech, the S&P 500, the US tech stocks reaching a 100-year high relative to the S&P 500. Mag 7 now accounting for 35% of the total market cap. And for those of you guys who were around here yesterday, you knew when I was going over this, that the dominance of this is something that we've never seen before. The last time we saw dominance like this, it was similar to the dominance that we are seeing, or that we were seeing, excuse me, during the dot-com bubble, where the market was extremely top heavy. But now this gap is increasing in this past 24 hours, so much so that it's similar to what we're seeing with the Great Depression, unfortunately. So let's break it all down here, right? So we've had some serious market concentration going on right now, right? It's highly concentrated, a few mega tech giants. The dot-com bubble also involved tech giants, but the concentration was less than it was right now. There were more sectors with big weightings, financials, industries. Market downturns tend to be more sector diverse. Allegedly, that's what they're saying. The crash of the dot-com was heavy tech focus, as the internet tech companies were overvalued. Many mega tech companies didn't even exist then, like Nvidia, Tesla, or were much smaller. The current Mag 7 includes companies, oh yeah, with strong earnings, cash flows, exactly, right? Like, this isn't going to happen again. 08 was caused by the financial sector, and there was flash crashes or everything else. But today we have the Mag 7, the mega caps are dominating the market, and the concentration is extremely high. These are the central market drivers, right? So everybody's saying, okay, you know what? How is this the same or close to the Great Depression? Well, if you look at the Great Depression, it was a little bit more fragmented, and the drivers were not tech, right? It was industrial, agriculture, and banking. But look at what we have here. It's tech innovation and consumer spending and conservatives. Valuations were elevated, but mixed. There was a speculative bubble in many stocks. Corporate and consumer debt are high. Oh, but there's more regulation, so everything should be fine and dandy here, right? Central bank, the Fed, and stimulus tools, they're active. They raised rates pre-crash, and no modern tools. Yeah, no modern tools like stimulus, right? They had stronger regulations now, but the economic conditions are slowing growth, inflation concerns, and geopolitical tensions. They had a severe economic downturn and banking failures, of course. They say the difference is like we have the Fed here who can print out of it, right? And this is why I say that we shouldn't be worried necessarily about the crash just yet, because of the quote unquote tools that the Fed keeps lining out. Is they've already shown their hand. You know, we're playing poker and we know what the Fed has every single time. They have the money printing in that as the tool of the toolkit, right? In their toolkit. So even though the Mag 7 are highly concentrated and the NASDAQ 100 relative strength is where the Mag 7 has been underperforming the NASDAQ for the past 3 months, It's kind of an interesting time that we're seeing all of this because at the end of the day, there's record concentration of the S&P 500 and the Magnificent 7. So, we've been the tool called ChatGPT, the virtual over the two times of the past is first, yeah, you know. The Mag 7 included Meta, all of these guys. They're just way higher concentration. They have an increased risk for investors. The economic concentration, the S&P market is currently highly concentrated. So the Nifty 50 with a classic stock market concentration in the 60s and 70s was dominated there, and then the dot-com bubble. So you got to watch out for the S&P 500 because of just how much the market cap is higher than any other US stock market in the world. I mean, look at this. The concentration for the Mag 7 is just skyrocketing in flight here. It's insane how much this market is just concentrated right here in one like this, right? You don't like to see things get compared to the Great Depression when you're looking at the current state of affairs when it comes to the stock market, right? Because if you sit back and look at the overall S&P 500, right? You guys know for coming to this channel all the time, I love to pull this up every single time. And we've been seeing a 3-month run that has been honestly historic, 3 to 4 month run when we had this dip in April. Since then, the S&P 500 has been in a generational run. But year to date, it's only up 8%. I mean, 8% is a pretty solid return, let's say, for the S&P 500. But the US hasn't even cut interest rates just yet. There's a lot of underlying, let's call them signals that we'll get to here in a minute that could lead to some potential downfalls, some of which have been the widening of the gap between non-farm payrolls and the household survey. It was massive. The difference was 333,000 jobs. That's not a small difference here, folks. That is astronomical. Friday's job report showed 73,000 non-farm payrolls were added. Meanwhile, the household surveys, minus 260,000. I mean, the data that we're being shown here, how could we trust it when we see two things that are allegedly looking at the same exact thing be so completely different, right? I mean, these things are just insane, the difference here. And All Nighter Hider in the chat is saying, wait for the revisions because that's what we always get, right? The Great Depression market signals sounds quite ominous. It does, right? It is a little scary to think about when you see these things grow that the way that they are. And the reality is that Trump now has another yes man in the Fed governor, and we'll get in there in a second. But he wants to cut interest rates, and we've got, I guess, the underpinnings here of a potential market bubble going on, where the U.S. market carried and has a massive amounts of concentration, more so than any other market in the world. And then we're going to have the Fed cut interest rates where they're going to, flood the market into tech because that's where the highest returns are. Everybody keeps going towards tech. And now we see the Dixie sitting at 98.26. And everybody always screams, hey, you know what? You should diversify your portfolio. Get into the S&P 500. Oh, it's got 500 different companies. But when you look at this, maybe you should just invest in 5 to 10 companies at this point, right? I mean, why even waste your time and put some weighting in the other 490? These stock evaluations and the way that these companies are being evaluated, it just doesn't make sense anymore to really quote unquote diversify out, right? And then on top of it, we have Trump now adding the new Fed governor, and he has, kind of backed Trump's policies with all of this, right? He's come out and said, "Hey, you know what? I think that this is the tariffs were a positive thing." And he's been really against Powell. Look, I'm not saying that Powell has done everything right here, and I don't think that, we should be continuing to, back everything with Powell that Powell is saying. But what I do think that Powell realizes is that inflation isn't under wraps. I might have to find the people at Govflation, because this was my favorite website to show people just the real data analytics of all of this. They're keeping up the real CPI, but they're not looking at and following the old numbers. So we kind of have to look back and say, okay, it was 2.7% at one point, right? At 2.5%, the real CPI was at 10.3. So I imagine it's just a teensy bit higher than 10.3 right now for overall that. And for those of you who are new here, this website essentially shows the calculation of CPI, real return, GDP, all back starting in 1981, right? At the end of 1981. So you could see when they first changed it in 83, and then how this data just continues to get more manipulated over time. That happens with everything, right? Just gets more and more manipulated, this gap. And then this gap turns into inversion here, inflating the GDP numbers. Unemployment also looks to be at 7.8%, but they're reporting it at 4.2%. Everything's all fine and dandy. Right? So all of this data that they're reporting to us just continues to get changed and manipulated. Yet we're supposed to believe that the market is okay, even though we're seeing things like this. Tech stocks hit a 100-year high, and the divergence from the top 10 stocks to the S&P 500, the S&P 490, let's call it, is becoming increasingly massive. And that gap is continuing to widen here, folks. I agree what All Nighter Hider is saying here. It says it takes critical thought to discriminate between diversify and diversify. Critical thought is rare AF. I mean, it seems like it's getting to that point, right? Where we're seeing everybody essentially looking at, hey, this is something that we should be keeping a close eye on. Because at the end of the day, if you look at a lot of these signals, look at this. Student loan debt. The crisis is getting worse. Look at the delinquencies in here. Like the spike that you're seeing in this kind of stuff, that's not the kind of spike you want to see, right? That's not the spike in your portfolio. That's the spike in delinquencies for student loans. 14% of borrowers ages 40 to 49 have delinquencies. 8%. I mean, these are not small numbers, right? These are absolutely massive here. And so if you look at this, right, fiat currencies are in an eternal bear market. No economy has maintained an average inflation rate below 2% since the end of the gold-backed 1971 Bretton Woods system. In other words, the value of fiat currencies has fallen by at least 2% annually over 54 years. For example, US, Canada, China, France averaged around 4% over the period. Brazil, Argentina, Venezuela, they've all seen 100%. Right? So at the end of the day, all of these people, they're going to start to move their money into some sort of assets, right? That's why we saw gold absolutely skyrocket and hit near that all-time high for 3,500. And we're continuing to see a lot of these market signals just point to something of an asset bubble. Because when you have fiat currencies essentially the global reserve currency of the dollar dying, everybody's going to be looking to park their money in something else. It's not sustainable. So when you're parking your money in something else, these assets are going to be in higher demand, and that's going to send the asset bubble to all-time highs, and everybody's going to be happy with that, at least initially, right? The top 1, 2, 5% are going to continue to get wealthy and wealthier, and that wealth gap is going to continue to increase. That's what we keep seeing, and that's what we keep watching take place here. So I'm going to be detailing all of this. So make sure you guys are hitting that subscribe button. I see we got 4 people in the chat, and I absolutely love that. We've got McLovin, All Nighter Hider, all of you guys. Thank you so much for coming in. I think this is the most I've had in here, tied for the most. Maybe I've had 4 to 6. But hit the subscribe with the bell notifications. I would love to see the 95% of you guys who aren't subscribed to this channel start to trickle in and come to these live chats and join the goats that are coming into every single one. And I'll catch you guys all at the next one.